everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 120. This one is titled Using the Nasdaq-100 Volatility Index, or VOLQ, in covered call writing decisions. We're going to be using a real-life example with the exchange-traded fund Invesco QQQ Trust, which trades on the Nasdaq exchange under the ticker QQQ. Now, let's first by defining a couple of terms. What is QQQ? Well, as I said, it's an exchange-traded fund, and it consists of 100 of the largest non-financial companies listed on the Nasdaq exchange, and these are technology-based. As of October 20th, 2021, the top 10 companies on the QQQ were Apple, Microsoft, Amazon, Facebook, Tesla, Alphabet, and NVIDIA. So the big boys. So for every share of the Qs that we own 100 shares of these technology-based companies. Now let's define covered call writing. I know most of you are familiar with it, but some of you may not be. So covered call writing is a low risk, not a no risk, but a low risk option selling strategy where a security or stock or ETF is first purchased in 100 share increments, and then call options are sold leveraging these underlying securities. So for every one option contract we sell, we must first own 100 shares of stock or ETF. Now, as an option seller, we are undertaking the contract obligation to sell our shares at the strike price that we determine, while the option buyers have the right to exercise those options at any time during the contract. These are what's known as American-style options. So exercise can occur at any time from when we sell the option to 4 p.m. Eastern Time on expiration Friday. Now, early exercise is extremely rare, but it can happen, and it's important to understand that. Now, in return for undertaking these contract obligations, we, covered call writers, are paid a cash premium that's generated into our cash account instantaneously. Let's move on now to define VOLQ. This is a 30-day, now it's important you understand this, it's a 30-day measure of the implied volatility of the Nasdaq-100 index, NDX, which is really the same thing as the Qs, as expressed by at-the-money NDX options. So the difference between implied volatility stats for most securities is they're based on a broader range of strike prices. VOLQ sticks pretty much to near-the-money strikes. Now, it's also based on one standard deviation, as are most implied volatility statistics, which means that it's expected to fall in that range 68% of the time. But the amount that it'll fall below that range or above that range is actually 84%, because it'll fall outside that range, 16% on the low end and 16% on the high end. Now, this information we can generate from VOLQ can provide investors with an expected trading range of NDX or the Qs over the next 30 days. But we must convert VOLQ or implied volatility to the time frame of our contract, because the VOLQ and implied volatility stats are expressed in annualized returns. So here's the proposed QQQ VOLQ strategy. We're going to first determine the expected trading range of the Qs over the next 30 days based on VOLQ. Now, we're going to use the low end of that range. So in other words, we're looking at 1 month expirations. That can be adjusted, and we'll get to the formula in just a moment. We're going to look for the low end of the range to determine the target premium for selling a deep in the money call option, which will then bring us down to the break even to the low end of the range. So what we want to do is we want to target what that premium is to bring us down from current market value to the low end of the trading range as expressed by VOLQ. Now, any time value component of that particular premium, and this will all come to life once we talk about the specific example, but any time value component of that premium will become realized profit if the price of the stock does not dip below that deep in the money strike price. So what we're doing is we're creating an incredibly defensive trade that will return significant annualized returns. So very, very ultra low risk, but yet still return a nice annualized return. Not as much as traditional covered call writing, but still significant. All right, let's get into a real life example now with the Qs. And this information was taken on 10/22/2020. Here are the stats. The Q was trading at 284.32. VOLQ was listed at 32.16. Now remember, that 32% movement up or down is based on an annualized return. What is the 30-day percent return based on that VOLQ? Well, we want to know how many 30-day periods are in a year. And so what we do is we take the square root of that. And the square root of 12 becomes 3.46. So we divide the 32.16 by 3.46. And this can be used for any time frames, depending on the number of days to expiration. We just divide that into 365 and then to take the square root of that number. In this case, it's 32.16 divided by 346. So that comes out to a figure of 9.29% for this 30-day trade. So the original 32.16 annualized becomes 9.29 for a 30-day trade. Now, 9.29% of 284.32 is 26.69. That is the premium we seek to generate when we sell the deep in the money call option. And then we're going to make sure that the time value component of that premium will match with our annualized goal, let's say 10 to 15%. So our target premium for this particular trade is 26.69. It will rarely be exact, but that gives us a framework to check the option chain to see what strike price will generate that premium or close to it. Once again, we must make sure that the time value component of that premium aligns with our annualized return. In this hypothetical, we're going to say 10 to 15%. That looks pretty darn good because as I'm making this presentation, the interest rates are incredibly low. For example, a one-year CD is generating about 0.05%. So 10 to 15% annualized return looks mighty good. Now, the intrinsic value component of the premium when we're calculating our returns is used to buy down the cost basis from the 284.32 price. The calculators will do all this for us, so don't worry too much about the math. Okay, so we're going to look with the Qs trading at 284.32 at a strike price that's going to generate a target of 26.69. Now, for those of you who are also watching this podcast, I'm showing a screenshot of the option chain for an 11/20/2020 expiration, 1 month out. The 261 strike has a bid price of 26.47, very, very close to our target of 26.69. Now, what we're going to do next is feed that information into the multiple tab of one of the BCI calculators, and here's what we learned. The return on our option, that's the time value component of that 26.47, based on the bought down value or the strike price of 261, results in a 1.2% 1 month return, 14.4% annualized. That does fall within our target range of 10 to 15%. So the answer is yes, we are down to the low end of the range because the break even is 257.85. And our target was 257.63. We're right there. and the time value of return annualizes out to 14.4%. So that would be the strike we would use in this particular scenario. Now, for those of you who are premium members, we have developed a spreadsheet which can be used with VOLQ or any implied volatility statistics. Just feed that information into the white cells at the top of the spreadsheet, and you come down with an expected trading range. And then you could look at the low end or the high end, depending on which strategy you're using. In this particular case, for this podcast, we were using the low end and deep in the money call strikes. But you could also use it for the high end if you're doing something like portfolio overriding. So just go to the premium member website and log in, and then look at the right side in the resources download section and scroll down to E for expected trading range calculator. And you could use the calculator. Everybody else not a member, use the formula that I alluded to in this podcast. Let's summarize. VOLQ can be an extremely useful tool when covered call writing with the Qs. We want to establish a target strike price when seeking to generate still significant annualized returns. So we're incorporating an ultra low risk yet high probability approach to covered call writing. And it's particularly attractive in low interest rate environments like we are having at the time that I'm creating this podcast. Ladies and gentlemen, before I go, as I always do, I want to remind you all about our best and most comprehensive investment package. The BCI package contains 6 of our online video courses with downloadable workbooks, 6 calculators developed by the blue collar investor and only found at the blue collar investor, 5 of our best-selling books. We have the #1 selling books on both covered call writing and selling cash secured puts. Those are in our package in ebook format, and 13 months of premium membership, which also includes 4 reports of eligible securities for options, along with over 200 at this point in time training videos, expanded calculators, and many other downloads and resources. Our ongoing and never-ending video training includes our total library of Ask Alan videos found nowhere else other than the premium site, our in-depth Blue Hour webinar series, and we add a few each year. And we do add 1 or more training videos every single month. Those will be archived only on our premium member site. How do you find out more information about the BCI package? Go to our website, www.thebluecollarinvestor.com. Click on the BCI package link, and there you will have written and video information on the package. Folks, I want to thank you very, very much for taking the time to listen to and or watch our BCI podcast number 120 using the Nasdaq-100 Volatility Index, or VOLQ, in covered call writing decisions. Folks, I hope you enjoyed this presentation, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.